I just made $35,000 in one trade following this insanely simple SMC trading strategy. And not only did I take this trade, but over 100 of my inner circle students who trade live with me every day also took this trade. And collectively, our community made over $100,000 on prop firms from taking this trade. And in today's video, I want to break down this trade, but more importantly, I want to break down the step-by-step trading strategy that's behind this one trade. You see, one trade is something, but hundreds of trades taken that are following the exact same rules, the same playbook. Well, that's how you build real profitability in these markets. And if you're serious about becoming a profitable trader in 2026, this is a must-watch video for you. I'm going to be starting with 3 simple rules, theoretical and practical, and then we're going to apply it all to the markets and break down step by step the exact trade that was taken. Let's dive straight in. So let me start with step number 1, which, as you can see here, is directional bias. What is directional bias? Simply put, directional bias is the bias that you have for the day. It's the direction in which you believe that price is going to trading in that one specific day. You see, what I found after years and years of trading and collecting data is the number 1 indicator of whether you will take profitable trades is your read on the direction. If you get the direction right, then half of the job is done. If you get the direction wrong, then it becomes very difficult to make money. So the main thing is that you need to understand and get the direction correct. And the way that I do that is simple market structure. So if you look on screen right now, you can clearly see what we have as a directional trend, right? I think anybody in their right mind who would look at this image would say that we are bullish. Why? Because we have a swing low, we have a high in here. So we have swing low down here, swing high up here, then price comes down, puts in this low, and then reverses from this low, and then puts in a higher high. So this becomes a break of structure, right? We broke the previous high, and we put in a new higher high. So higher high, right? Highs are going higher than highs. Lows are trending lower than lows. So you can see that we're moving in an upward direction. Very, very, very simple. So we have higher high, then we come back down. We respect this low, and we start reversing away from that low. And then we go and put in a higher high. This is that higher high. And then we come down again. You can see we respect this low, we reverse, and then we continue toward the upside, and we take out this high. Now, what do you think is likely to happen off the back of this? Well, in my experience, there's likely to be some kind of a pullback and then some kind of continuation. Just continuing this trend, right? Respecting this low, finding a reversal point, and then targeting the high, right? That is a trend. And very simply put, it's your job to identify this trend. And in doing so, you will identify the likelihood of price movement for that one specific day. Now, you've probably heard this a million times, right? Everybody says the trend is your friend. Everybody tells you follow market structure, right? Market structure will tell you what to do. Well, there are many different problems that come with market structure. If it were just as simple as following the market structure, then everyone would be profitable. The problem that I have seen in my personal experience when I first started trading, and the reason that it was so difficult to become profitable, is because, well, truth be told, you could look at many different price charts from different points of view, so different time frames, different zooms, and you could get a completely different picture. For example, let's do this right now. So let's look at this price chart right now. We are on the 15-minute time frame, Euro USD. You tell me, are we bullish or are we bearish? Now, some of you who are watching at home, you may say, oh, we're bearish because we have a swing low down here, a swing high up here, a swing low down here. Now we're coming up into this old low, so I should actually be technically looking for shorts, right? That's maybe what some of you will say. Others may say, you know, maybe this was a low, but then we broke this low and now we're trading down in here, and then we've shifted higher, and so now we're bullish, right? Some of you may look internally into this structure, right? Again, I want to look at before we took the trade. Some of you may look at the price leg like this, and you may want to get a much better perspective of price. And maybe this is your perspective of price. And for you, looking at this chart, you say that we're bearish. You say, oh, well, you know, we have a high up here, right? And price is clearly putting in a series of higher highs, higher lows. We shift bullish for a second. We go lower low, lower high, lower low. oh, so we're clearly bearish and I'm expecting we'll continue this trend to the downside. Well, that's just the 15-minute time frame. What if I then show you a 4-hour time frame and then we do the same thing? What if we zoom out? Well, some of you might say we're bullish. You may be looking at this swing low to this swing high, and you might say, well, we're inside that range. That's what some of you may say. Some of you may say we're bearish because you can see quite clearly we've been putting in these swings like this. And then again, a different part of you will zoom into this price leg and will tell me, no, we're bullish because we take highs, right? And we're trending like this. We are definitely bullish. And again, that is just one time frame. And so the reality is market structure is amazing, right? It works very, very well. But it only works if you have a structure, a guideline, a set of rules that you have thoroughly tested to prove it works. Because the truth is, in trading, everything actually does work to some degree. But becoming a truly profitable trader is about taking a set of rules, principles, if you would like, logic flows. If this, then this. This is my definition. Everything should be defined. I like to be a trader that operates from logic, data, and rules. That's how I like to trade personally. Data tells me what to do. I have the data of over 1,000 trades worth of data that tell me that my rules work. So I built these rules myself personally for market structure. That's not to say that it's the only way you can read market structure. There are probably other ways. Maybe some of them are correct, maybe some of them are incorrect. But I will tell you for a fact that the way that I read market structure works phenomenally well. I was a trader who struggled with this. I would have on one day something else, on another day something else. And that led to extremely inconsistent results in my trading. One day I would come to the market and look at the price action and I would think that we're bullish. The next day, very similar price action, but maybe now I think we're bearish. That's because I didn't have specific step-by-step rules in place. And so I want to share with you right now my market structure playbook. This is the type of stuff that I genuinely share inside of my inner circle. And if you think that it would be a good fit for you or beneficial to you to be one of those people that I live trade with every single day, you first have to be a verified member of Prosperity School. So if you want to go down that route, I'm leaving a 45-minute training down below that I think will massively help your trading. It's first, but secondly is the route into our ecosystem. Check that out, it's the first link in the description. But let's get into our market structure principles. As many of you just seen, we had this kind of overall very simple view of market structure, which is awesome in theory. But the truth is that's not how market structure looks 90% of the time. In fact, a lot of the times market structure is built something along the lines of this, right? Where price is kind of trending in a direction, but there's loads of these like other swing points. And this is really what a trending market looks like. Even clean trends often look like this. And so again, it begs the question as to, well, what's my market structure, right? And especially if price hasn't reached out high yet, let's say we're down in here. And it's your job right now, you're coming into the market, we're right here, and you have to decide, am I a buyer of this market today or am I a seller of this market today? And like I said, the number one rule is your read on the direction for this one day. As an intraday trader, lower time frame trader, who wants to trade in 3 to 4 hour time windows, you better understand the direction of price for that day. That's going to help you make the most money. Again, many different ways to read this same price action. For me, I keep it stupidly simple and I follow the same rules as you would in simple markets. So what do? So I use the external swing points, right? Very, very important. The external swing points. What is an external swing point? An external swing point is a point on the edge of price that causes a reversal before breaking or after breaking structure. So you can see here we have a low and then price goes and puts in a high. Notice that this high is a reversal point, right? We go and put in the high and we go and put in the low. So that in of itself is a swing point. But then we come down here, but then so is this a swing point because it's a low that reverses, and so is this a swing point, and so is this a swing point, and this, and this, and so is this, so is this, and so is this. So they're all swing points, but only 4 of them are actual external swing points. And this is how I define it. You want to start with a swing low. Then you want to find your swing high. And after this, it's very simple. Take a box from the low to the high and just stretch it out. Now, anything inside of that box is internal structure, internal swing points, until we break outside of that box and create a new swing high. So notice now that we have a swing low, price puts in here, we start reversing, we have a swing high. Then we put in all of these other swings, which again, a lot of the times people see this and they're like, okay, lower high, lower low. Okay, I'm gonna short. Lower high, lower low. Okay, I'm gonna short. And then they just get stopped out because the reality is they were on the wrong side of the market. So when we get a break of structure, this becomes the new swing high. So we'll mark out the swing points in green, the correct swing points. So this is swing point number two, sorry. This is swing point number 1. And then this is swing point number 3, right? So let's get rid of this blue. This is swing point number 4. In here, there is another swing point. And it is, the swing low can be defined as the lowest point in price that price pulls back after a break of structure. So we have a breakout of this trend. We have a new high, which means this is no longer the low. We need the lowest point that respected that low. Is it this one? Well, no, because price comes lower. Is it this one? Well, no, again, price goes lower. Is it this one? Yes, absolutely. Because this is the lowest point before we break structure. So now when we break out of that structure, now we have a new swing range from the low down here to the high up in here. And then the same thing happens again. Now you have a new swing. So you have a swing low and you have a swing high. Same thing again. We're going to take our box from the low to the high and we're going to drag it out. And then it's up to the point of where we break outside of this box. The structure inside of this box is internal structure. And honestly, I can't tell you how many times I see traders take losing trade after losing trade after losing trade because they're trying to trade the internal structure. And bearing in mind, this right here, this is very clean and cute looking internal structure. A lot of the times you might see a low to a high to a low to a low to a high to a low. And they're just like getting beaten up left, right, and center. They're short and then it goes long, and then they're long and then it goes short. And then they're short and maybe they get a win, and then it's long and they're just a mess. And they're just getting nailed time after time after time by the market. The truth is you have to be trading these external swing points. And so again, we get a break of structure. That becomes our swing high. Where's our swing low? It's the lowest point of price before the break of structure. So that becomes our swing low. This becomes our swing high. So now let me ask you, what are you expecting price to do from here? Again, a lot of traders would maybe look at this and they'd say, okay, now we're bearish. Or maybe many traders look at this and they're like, okay, now we're bearish. And so what they're expecting is for price to trade lower, only for price to tempt them and then just run them completely. And the reality is that we were never bearish. We were always bullish, right? And that is principle number 1 and the most important principle for me, which is directional bias. And now we'll look at how that applies to this trade itself. So we come back, this is before we've taken the trade, right? New York session, which is highlighted here in orange. This is before we've taken the trade. So let's take a look at our structure. Again, if we zoom out here, it can be quite confusing, right? Maybe even a little bit intimidating, all of this structure. What we know for sure is that we were bearish. We shifted bullish, right? These internal swings, and then we shifted bearish again, and then we started to be bearish up until around a couple of weeks ago when we shifted bullish. So we had a swing high in here, we had a break of structure to the downside, and then price puts in lows, right, in here, and then a reaction from this external point into here. So we'll mark this low, high, lower low, lower high, lower low, lower high, lower low, lower high, and then price kind of comes down into this consolidation, and the actual swing low here is this lower low. So at this point in time, you would be a seller of this market. And again, every trend after some period of time becomes exhausted. It's completely normal. Maybe you hit a higher time frame point of interest. There are many different reasons, but at some point, you've milked the cow. I took shorts in here, I took shorts in here, right? We milked this price action. Eventually, at some point, we'll shift bullish, and we do. When we get a break of this, it becomes a change of character. Change of character simply just means the transition from bearish price action to bullish price action. That is it. And then what happens? Then we become bullish. So then we have a swing high, a swing low. Now this is a swing low because it meets my criteria for a specific pullback. Again, even my swing points have a complete rule-based mechanism as to you can objectively say, this is a pullback or this isn't a pullback. This is definitely a swing high and this is definitely a swing low. No ifs or buts or maybes or this or that. It's purely objective and rule-based. So it meets my criteria. Then we come back higher high, right? Break of structure. So then this is the low. And then we come back and then higher low and then break of structure and then higher high. So at this point in time, what are we? We're bullish, right? Our swing low is down here. our swing high is here, right? Many people just get confused. They look at this price action then and it just destroys them because maybe they're going, okay, well, now we're bearish, so I'm going to try and sell, right? Okay, definitely bearish. Let me sell. Get tagged in. Oh, okay, now we're bullish. Let me buy. Get tagged in. Okay, now we're bearish. Let me sell. Get tagged in, right? And they're just getting beaten around because they are just wasting their time trying to trade internal structure. And this is where most of traders take losses, these internal range. And the thing is you could have a trading strategy, right? That let's say your average risk reward is 5 and your win rate is, let's say, 30%. So on average, out of 10 trades, you win 3, you lose 7. You lost 7%, you gained 15%, right? 3 times 5. So net profit, you're 8. And that can work. But then what happens to most traders and failing traders is death by 1,000 paper cuts. What I mean by that is constantly taking stupid losses in stupid areas of prices that just completely ruin their trading results. That if they would have just had a simple rule-based and had some patience and not tried to just chase the market, in these scenarios, I didn't take any trades for 2 whole days because the market just wasn't giving me what I needed to see. I'll sit back, no problem. Patience, waiting for the right time to strike, because that's the difference. I would rather take no trades for 2 days than take 5 losing trades. It just doesn't make sense to me. In my head, 5 losing trades not taken is a gain of 5%, which for many people, like if you've got $1 million under management, which sounds far-fetched for most people, but not for myself, not for my inner circle members with prop firms, that's $50,000 saved. So again, complete noise, rubbish, right? People just getting trapped inside of a range. We clearly know that we are bullish. So we break structure and we go higher high. So now you find the lowest point of the swing price, which is here, and then the highest point of the reversals. And now you can start to see, right, if I just zoom out a little bit, you'll kind of start to see the swing points. You can see the trend. And it's purely objective, no wishy-washy, today this, tomorrow that, purely objective. And so that's all it is. And then this becomes my swing low down here. And then this becomes my swing high. So when I come into the market for this specific day, Wednesday, the 12th of November, I am a buyer of euro dollar. And I will prove it right now with a video that I sent out 7 hours before this trade was taken, saying that I'm a buyer below this Asia session low. The 2 main targets for me is this current London high, the high is above here, and then the high is above here. So I will partial out 5R, 7.5R, and I think that's 12 or 13R. As you can see, my bias, we were all the way up here, right? We're up here, and my bias is to trade long, but it's to trade long below this level. So I'm a buyer. So all of this bearish price action, it's not fooling me. But there are many traders, again, who are probably just trying to short the market in these levels, and it's not going to work out very well for them. So that is my rule number 1. And the most important thing, because if you can be on the right side of the market, the rest of trading is a lot easier. So here we are, step number 2. In step number 2, I'm going to be teaching you sniper entries. I'm talking turning a 3R trade into a 13R trade with one simple principle. So we have our higher time frame bias. That is our directional bias. So we have swing low on the 15-minute time frame, swing high, higher low, higher high, higher low, higher high. So the direction of the day, the bias of the day is bullish. This is our swing point. So the bias of the day is bullish. Now, what a lot of people fail to understand, or what a lot of people do wrong, in my opinion, is they trade kind of one-dimensional. So let's say you have a 15-minute time frame, which is for me the green, right? And that's literally what I use. I use the green as the 15-minute. So the green is the 15-minute. The blue is the 1 minute. So we have the 15-minute in green and black, and then we have the blue for the 1 minute. So what a lot of people do is, they'll have a trend and they have their direction. And then if they're SMC traders, they'll have this direction, and maybe inside of this price leg from the swing low to the swing high, maybe there's 2 different entry points that they could possibly take. Maybe one is an order block in here, or maybe one is, a fair value gap in here, right? Let's just say that. So there's 2 types of traders in here. Now, the first type of trader, he takes this position here, and maybe he takes this order block, and he puts his stop loss below this order block. And then he puts his take profit, right? His take profit above this high as a target, which is understandable, but that's what he's going for. Let's say he's going for a 1 to 3 risk reward. Now, there's nothing wrong with that, but it's just not the most ideal and optimized way. Because if that same SMC trader puts his trade on here, maybe in his head, he's also thinking, okay, I should probably put another position on because I don't know, is price going to trade from this level or it could also trade from here, you know, because there's a point of interest down here. There's a fair value gap. So maybe I have something like this. And in this scenario, right, maybe it's on the low. And in this scenario, again, maybe it's a 1 to 4, a 1 to 3, right? Let's just call it a 1 to 4 because there's fair value gap. Or maybe they're the type of trader from this fair value gap, right, with their stop loss below the swing low because it increases their win rate. So they win more. And they have a 1 to 2 risk to reward, right? This is quite literally how it works. Now, the issue with all of these trades is, sure, some of them might win. So let's go through step-by-step scenarios. First and foremost, you have the 1 to 2 risk to reward guy. Very, very simple, right? This is his trade. He gets into his trade. Let's say he goes to take profit. Amazing. 1 to 2 risk reward. Honestly, can't knock it. Like, I'm not knocking 1 to 2 risk rewards, but he needs to have a very high win rate for this to be a very profitable system. He also needs to have high trade frequency for it to be worth trading, in my opinion. It's going to struggle to pass prop firms and to get high amount of payouts because this strategy on the 15-minute time frame, let's say, you might only get 1 or 2 trades a week, maybe in a good market condition. And then those 1 or 2 trades, you might win 1, lose 1. And so you've finished the week on 1% in profit. Now, I'm not doubting a 1% profit, but that's not the type of stuff that I go for. My systems have collectively returned me hundreds of percent for a year, right? An entire trading year. So for me, this kind of 1 to 2 with a 50% win rate doesn't really make sense unless it's very high frequency trading. So he's quite flawed. The second guy, 1 to 4 risk reward, sure. But what's going to happen to him is there's going to be lots of times where price might come into this order block in here and then he missed that trade. Or maybe he takes both of these positions and then one of them gets stopped out and then he has this trade on and that hits and he made 3R in total. But if both of them lose because the direction's wrong, which happens, then he makes 2 bad trades and loses 2 trades. So there are many different flaws in trading without the sniper entries that I'm going to show you. Or maybe you have the type of trader who uses the fib extension and maybe they put their fibs on the highs, right? Like so, and maybe they're a 61.8 trader, right? And so they take their longs and they're 61.8 and they put their stop loss on the swing low down here and they're returning, 1.6 R. Again, if you're really, really correct a lot of the times and you're taking loads and loads of trades a day, then sure, possible. Still not the most efficient, but it's possible. And then you have the type of trader like myself and what I trade. And that's the reason why I am able to achieve such high risk to reward trades a lot of the time without sacrificing my win rate. And that is lower time frame confirmation. You see, we have a 15-minute directional trend, which tells us that we're bullish. I want to be a buyer, but I'm only understanding that we are bullish, price is taken at this high. If I'm up here, I don't want to be buying here, right? No. This 1-minute structure here is bearish. So we mark out the swing points. We can see that we have a swing high in here. We have a swing low, right? Which is a change of character. We've shifted from bullish. As the 15-minute expands, 1 minute is bullish. As the 15-minute comes for a pullback, the 1 minute is bearish. So in this scenario, the 1 minute is probably bullish, then it's bearish, then it's bullish. Then it's bearish, then it's bullish, then it's bearish. Then it's bullish, bearish, bullish. Bearish, right? At some point, maybe bullish. That's how the 1 minute time frame works inside the 15-minute. It's fractals. So what I like to do is I will look at the 1 minute structure and I will make sure that my 1 minute structure shifts from bearish, like this, to bullish, like this. And only when my structure shifts from bearish to bullish on the 1 minute time frame, which again, I have a very specific rule-based criteria for, then and then only am I willing to trade. And because I have that lower time frame confirmation, that order flow shift, because again, what you have to understand is that whilst price is trading lower, who is in control of this market? It's not buyers, it's sellers. Because right now in the order book, sellers are dominating buyers. But when that flips, when we see that buyers become more aggressive and they're protecting some type of level, and then we've had a shift from a point of control that sellers were controlling the market at, well, you just have to understand what's just happened. We have had a shift from sellers in control, price is trading lower, to buyers in control, price is now trading higher, and I am a buyer. So what I want to do as a very small fish in this massive ocean is I want to wait for the whale to move first, and then simply just ride on the back of the whale. It is literally that simple. I wait for smart money, for big money to show me that they are ready to go and push price higher. And then I simply, as a very insignificant fish in this vast open, simply hop on the whale's back and it takes me for the ride. I don't do any of the work. The market does the work for me. I am just simply waiting for the whale to turn up. And that's it. Price is trading lower. When it tells me, shows me that price is shifting, then I'm willing to risk my money. And I simply just trade on the lower time frame, right? Stops in here, something like this. And then I take a trade like this, right? And that is what I'm looking for. That's how I get these sniper-like entries. And now here's the thing. Many people will say, you can't trade with small stop losses, or don't you take many losses? Well, you can take a couple of losses, but let me again show you the numbers, right? Let's say that's the first trade that I tried to take, which coincidentally, just before I took this winning trade, I took a losing trade. In fact, I'll even show you that right now. But you know what's crazy? That losing trade made me more on my winning trade. Let me explain it. So on my first trade, it looks something like this, and I had a little bit of a higher stop loss. So my end goal actually ended up being 1 to 5 risk to reward, right? Which is still very decent. So my first trade was a 1 to 5 risk to reward. And what happened is I got into that trade and then I got stopped out of that trade. And so now I'm -1. Again, with all done, documented live in front of my members. And then what happens? We have a bearish shift, right? And then price shifts bullish again on the 1 minute time frame. So what happens? I follow my rules and go again. This time, 2 things are here. First of all, I'm getting in at a lower point, which means I have a longer distance to go, which means I could make more money. You know, if I'm a buyer, let's say I'm a buyer here, and price has to move 40 pips to my take profit, or let's say I'm a buyer here, and then price has to move 50 pips to my take profit. Well, I have just gained 50 pips, right? 10 pips, sorry. And then another thing. In this scenario, my stop loss was 7.9 pips. In this scenario, my stop loss was 4.2 pips. So I have literally doubled my risk to reward because my stop loss size was halved. Now that's not something that I do randomly or how I feel. No, I'm just following my rules. On some trades, I'll have a smaller stop loss than others because that's how the trade sets itself up. So I got back into this trade and then price eventually ran all the way to my take profit. And so what happens was, if this trade would have worked out, great, I would have made 5%. Amazing. But this trade didn't work out. So I actually lost 1%. But this trade did work out. And this trade netted me over 7%, right? Because I'm going to explain in rule number 3 how I manage these positions. Because again, management is a whole other ballgame that very few understand. So I managed this position very well, and I gained 7.5% or 8%, somewhere near there. 7.5, 8%. So what does that tell you? Well, I lost 1% on the first trade, which would have gained me 5% if it would have won. So if this trade plays out, I gain 5%. It doesn't. I lose 1%. I'm down 1%. Boo-hoo. I take this trade. This trade plays out, I gain 7.5%. Do the math. 7.5 minus the 1 that I lost equals 6.5. So I lost this first trade, and then I got in on my second trade. But because I lost my first trade, I got a better opportunity and made 6.5 even with the loss, which is more than I would have made if I didn't lose the trade. Can you imagine being rewarded for losing a trade? How good of a trader would you be, right? If you could actually make more from losing trades, and it completely reframes your perspective on what it means to lose a trade when you trade in this way. So let's move on to step number 3. So let's take a look at all of this in the live market, right? How I was actually able to take this specific trade. Let's take a look. So here we are on Eurodollar, and I will very quickly show you a live run through of this trade being executed right now. And then you can see that we finished our live session just before this trade had actually peaked out. So here are some screenshots as the trade played out from inside the community, and also a bunch of other traders taking the exact same trade, of course. So 15-minute time frame, bullish. Step number 1, I'm a buyer. Very important that I'm below this Asia low. That's one of my rules, right? I have a few other different rules here and there, but everything in my strategy is completely rule-based. So if we take a look right now, what I do then is I come to the 1-minute time frame. You can see the 15-minute structure, right? 15-minute swing low, 15-minute swing high. As the 1 minute comes in here, it's bearish. So where is my 1-minute structure points? Well, you can see that we shifted bearish up here, right? Swing high, swing low, higher high. We break lower low, then we trend down. None of this is really important. We trend back up, and then we trend back down again. And you can see my first trade that I took this trade, right? We shifted back bullish when I came into New York. We shifted from lower low to higher high, right? I was a buyer in here, as you've probably seen in the recording already. I was a buyer somewhere in here, had my stop loss down at these lows, and I was targeting the highs in here. for a 1 to 5 risk reward, right? That was the first trade. Now what happens is we get stopped out, right? And actually the 1 minute structure is bullish. We have a pullback here. We have a break of structure up here. It's very, very minor, but again, it follows my rules. That's why we have rules, so that we don't get confused. We break structure, we change character, so we become bearish, which is fine. I can still be able to buy it even if the 1 minute is bearish after my trade. We continue bearish, and then there's a very important lower level shift in here, which is we're bearish, right? And then I have low, high, low, high, right? So you can see here, we have a swing low, we have a break of structure, and then we have a swing high, and that's break of structure. So change of character. So now we become bullish. In this example, my entry is this level here. I'm a buyer at this price point. Now my stop loss is, it could have been 2.8. I could have maybe squeezed a little bit more. I ended up going out at 3 pip stop and a little bit below the low. And yet my target is all the way at the swing highs up here, right? But here's the key. I don't just let this trade run all the way up to these highs, because there are some times where I may be wrong on direction. Can you believe it? Sometimes it may not play out exactly how you planned, right? I know, that's trading. Welcome. Sometimes what happens is price may move, right? And then the market just decides that it no longer wants to move, right? Completely fine. Don't take offense. So many people I find get offended by the market's decisions. Like, you have no control over what the market does. So figure out how to take money out of it and keep it moving. So for me, what I have, again, verified by hundreds and hundreds and hundreds of trades, over 1,000 trades of data to verify why I do what I do. My first take profit is 5R. So I take off some of my position at 5R. My second take profit is usually some type of major accomplishment, which is like a high of session or equal highs or high of day or something like that, right? That's my second take profit. So in this example, my second take profit was 7 risk to reward, or just a little bit over 7 risk to reward. And then my final take profit is the swing high, which is basically the idea of the whole trade. But sometimes, you know, you might get up in here and then you see a pullback to break even. And then maybe you're still bullish, by the way. Maybe you still stay like this, right? You come in, you get in a trade, and then we just come lower, and then tomorrow we run higher. And it just is what it is, right? It just happens. Like, nothing you can do about it. So I apply management principles. And my management principles make sure that even when I am wrong, I make money. So how did I actually end up getting on in this trade then? Let's see. Price shifts, we get tagged in to the trade. We have an immediate move toward the upside. After we get this move, I know that I'm on the right track. The first thing I want to do is reduce my risk. So I want to get my stops to break even. Because if price is going to come back to this level, then we're probably wrong, and price is probably going to go to the downside. So a lot of the times you can, especially when you're a sniper trader, right? You're getting sniper entries, very small entries. You want to remove your risk as soon as possible, because the reality is you only need a little bit of a push to get your risk off the table. And then you can still be wrong, but you will lose nothing. You know, in the 1,000 trades that I've taken, a decent portion of them, maybe, you know, 50 to 100 of those trades are break-even trades, meaning that I didn't win, I didn't lose. But what I have the data for, this is crazy amounts of data. 97% of my break-evens saved me money. I mean, if I took 100 break-evens, so I did this rule, I followed this rule, you know, 100 times. And out of those 100 times, 97% of the time, so 97 out of 100, I saved money. Meaning when price came back to me here, 97 times it continued through my stop loss. And only 3 times did price come back here and then go to my intended take profit. So again, everything I do is battle tested with data. It's not just random BS that you find out here on YouTube these days. So that's how things play out. And then my first take profit, as you know, is 5 risk to reward. So I just need to see that get hit. And again, this saves me a lot of the time as well, because there were many times in my testing where price would run, and then like I said, it would come back down. And what I noticed is it would damage me psychologically, because I would see the profits, but then I wasn't actually getting to keep any of them. And there were so many trades that would do this, right? Or this. So many trades. And I thought there's a way that I can still make money here. And so by taking a portion of my position off at 5R, let's say 50%, right? Then I'm locking in 2.5%. Guaranteed, no matter what, 2.5%, 2.5%, 2.5%. And these 2.5% moves that end up like this, they end up stacking up a lot. So my first position is up here at 2.5R. And again, you can see here, TP1 was hit, shared inside of the community after our live session. TP2 is up here. TP2 gets smashed pretty quickly after, and again, that got hit. And then it wasn't until the next day open at London session, right, did we end up getting the rest of this trade played out, but I'll just show it you. Again, it's the day after. Now, just while this is playing out, next day, London session, massive amounts of volume, takes me out for my full take profit up here. And that's the trade that made me $35,000. And again, if you want my step-by-step trading strategies with years worth of backtesting and everything you need to become profitable, don't forget to check that free training in the description.